Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the film theory. This is by far the most interesting thing I've come across all year. So first I want to say thank you to the person who sent me this and brought it to my attention on Instagram. And this was a huge thread on Reddit that got a lot of attention. And the premise of that thread was that 2008 never actually ended. It's still happening today, and it's going to happen again. So let me rewind, because in 2008, we had the subprime mortgage crisis where real estate collapsed. This is where banks lent way too much money to people that were not necessarily going to pay them back. They then took those loans and turned them into investments that they labeled AAA, very safe, which they then sold to other banks and institutions and then bet against those investments. And when the real estate market crashed, it took everyone down with them. They made a ton of money and consolidated power. That was in 2008 with real estate. This is about the derivatives market, which I'll explain like I'm 5 exactly what all of that means. So first, I want to give a huge amount of credit to the person who actually wrote that Reddit post, because they did an incredible amount of research and analysis. And in this video, I'm going to try my best to relay all of that information to you as accurately as possible, and hopefully I do a decent job. First, I just want to quickly say that I'm not somebody who likes to talk about market predictions or market bubbles popping. I don't like scaring people. I like making finance fun, simple, and easy to understand for everyone. But this theory, just this one time, is something I feel like I really have to share with you. So this all starts in the 1990s. The good old times when you could just walk up to someone and say, "Want to trade cards?" And they'd be like, and you knew you were friends for life. But it was also in the 90s that something called derivatives were created. And here's what that means. A derivative is a securitized contract that derives its performance from the value of an underlying entity. This underlying entity can be an asset, an index, or an interest rate, and is sometimes called the underlying asset. I'm just kidding, there's nothing there, I lied to you. The Explain Like I'm 5 version is like this. Let's say you and I were to make a bet that this card right here, Pot of Greed, which allows me to draw 2 cards from my deck kinda, is gonna be someday worth $1,000. Now let's say you believed it was gonna be $100, doesn't matter. Let's say then we securitize that bet, which means turn it into a security or an investment that people can buy into. Well, now somebody comes along and says, you know what, I think Andre is gonna end up being right. And so they make a bet on our bet. And that's essentially a derivative, but it goes way, way deeper than that, because what could end up happening is someone can come along and they borrow money on margin with their Robinhood app because they have $1,000 in their account, but they actually have access to $5,000, and they make a bet on the person who's making the bet on me. So now we have a situation where someone is making a bet on a bet of our bet. And so you can imagine this betception. It's like inception of a bet, of a bet, of a bet within a bet, and that's a derivative. And that happens every single day in the market. And in 2016, Warren Buffett tried to warn us that the derivatives market was like one giant ticking time wizard waiting to collapse. So the analogy is that it's one big casino. And here's a really good example of derivatives that happen every single day in the markets. Call options and put options, which is something that regular retail investors play with every single day. And this is because instead of being a boring regular index fund investor or a dividend investor where you get a 1-to-1 return on your money, meaning if a stock goes up 100%, sure, you double your money, but it's only your money that you're playing with. It's the get rich slow approach, but ain't nobody got time for that. Instead, people play with call and put options because then you can make 5 to 10-to-1 returns on your money. That way you can make 1,000% and 10x your money instead of doubling it every 10 years. But that's only the beginning, because you can go way further by borrowing other people's money on margin. So if you have $1,000, you can theoretically have access to $5,000 to do the same strategy, and then you can make even more money. Now, obviously, all of that is extremely risky, and that can spiral way out of control, because unlike a regular investment where if you lose 50% of your money, well, then you're left with 50%. But in this case, if you get these investment strategies wrong, you could end up losing all your money.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Now, because these investments are so risky, we've tried to regulate them. But something really interesting happened, because at the turn of the century, in the year 2000, Bill Clinton passed something called the FMA, the Commodity Futures Modernization Act of 2000, and that made it virtually impossible for anyone to properly regulate the derivatives market, because today, the people regulating derivatives is the federal government, and they do this under the safety and soundness measures, which is just a fancy way of saying as long as these banks are doing their best to give the moral effort of doing the right thing, then we'll look the other way. So what all of this basically means is that they created a casino in the world of investing. And this casino was designed to protect the house, because even if the rules were designed to make you lose every single game, you wouldn't even know about it until after you'd lost. But trust us, everything is just fine. Something in my eye again. After this law was passed, we were off to the races, and after the year 2000, the derivatives market took off, and you can see just how exponential that growth was since the year 2000. So now let's fast forward to 2008, where the stage is now set. Remember, in 2008, they started to securitize these toxic loans that they labeled AAA, which were nothing more than really bad CDOs they just sold to their clients. Now, the reason they did this is because it was making them a ton of money. Like, for example, the Lehman Brothers CEO made something like $484 million that year. But the worst part about all that is that as soon as they sold those investments to their clients, they started to bet against those very same investments. It's like the equivalent of giving someone a broken car or a house that you sold someone that you knew was about to collapse, and then you took out a life insurance policy on that person. That's exactly what they did. And that's why this next part is gonna blow your mind, because right now, the market capitalization of the stock market, not just of the US, but the whole world, is something like $89.5 trillion. That's as of 2020. In 2021, it might be like 95. Let's just round up to $100 trillion, which is a lot of money, right? But when you compare that against the derivatives market, which is the thing we talked about, the bets on bets on bets, that right now is estimated to be between $640 trillion and 1 quadrillion, which is 1,000 trillion dollars. That's the outstanding value of the derivatives market, not the notional value, but that's still a ton of money. It is so much money that just for a second, I want to put it in perspective by comparing it against some of the biggest investments you might have and some of the world's biggest budgets. Some of these numbers are a little outdated, but for example, the cryptocurrency market today, from Bitcoin, Ethereum, Dogecoin, and any other crypto you've ever heard of, is a combined value of only $1.5 trillion. When it comes to the world's military spending budget, that's only $2 trillion. When it comes to real estate, the entire value of the world's real estate, that's a lot higher, $270 trillion, but still way lower than derivatives. When it comes to the whole world's debt, that's $281 trillion. When it comes to the world's entire wealth, that is estimated to be about $360 trillion. Now, all of that is, yes, a ton of money, but still way less than what derivatives are estimated to be, which is again, 600 trillion to 1,000 trillion dollars. That is how big the casino has gotten. So then the question becomes, how is 2008 gonna happen again? Well, now that you know how 2008 happened and what led up to it and why, now I can tell you exactly how it's gonna happen again according to this theory. Instead of predatory lending to ordinary people that weren't able to pay back their loans, one of the ways they're doing it again is through predatory lending, but to businesses this time through something called CMBSs, or commercial mortgage-backed securities. And the way they work is very similar to the retail ones, but to businesses instead. So let's say I was a bank and I had a business come up to me asking me for a loan so that they could pay for their office building. Imagine if I was a bank and I gave out a bunch of these loans. I then converted them into a security. My job as the bank would be to make this investment seem as attractive and as stable as possible. Now, they did some research on this that was independently confirmed by The Intercept, which was an independent nonprofit organization, where they looked at 40,000 of these CMBSs that were created between the years 2013 and 2019 that were over $650 billion in market cap. So really big ones that if they were to fail would really affect the market if they turned out to be sketchy. And they found some really interesting data. They found that the reported income falls 5% short or more in 28% of the loans the banks gave out. But that was just the average, because some of the bigger banks like Goldman Sachs and UBS and Citigroup and JP Morgan have 5% or more fall short in 35% 90% or more of the loans they give out. Andrei, why would they ever overreport the income of a third of their clients? And this is because if you're that bank who's sending out these loans, you want to consolidate them and package them up under a single investment derivative known as these CMBSs. But by doing that, by overreporting the income of your clients, you make it seem like this investment is a lot safer than what it actually might be. So if the story you're telling people is everything is just fine, my clients are perfectly fine and they can pay their rents, but if the reality is they can't because maybe a pandemic happened, now that could crash the entire value of those investments that you just sold to people and the entire market with it, which is exactly what happened in 2008 with the CDOs and the MBSs that those banks sold. So what if we get a pandemic? Because that's exactly what happened to us in 2019. That should have sent the entire market into a downward spiral, but it didn't. We're still here. And here's what happened. Remember, this is just a film theory. I'm not saying this is where we're actually going, but just up to this point in the video, everything I've said can be fact-checked and cross-referenced, and none of it was my opinion. But here we go into La La Land territory where we try to speculate to try to see where all of this is actually going. And so here's what the theory says. The theory says is that so far, the government has put in place these mortgage forbearance plans to kick the can later down the road, because the shock of COVID wasn't supposed to happen. But when it happened, organically what was supposed to happen was mortgage defaults. But instead, we put in place these emergency relief programs, which yes, helped the ordinary average person, but most of all, it prevented those mortgage defaults, which would have collapsed those CMBSs. And the reason they did all this is because they needed to buy time in order to put more laws and rules in place to protect them in the aftermath of a collapse. And here are some of those rules that I will leave a link for in the description down below in case you want to nerd out. There's Rule DTC-004 and ICC-005, which is a protection, wind down, and auction plan. There's also Rule OCC-004 and OCC-003, which protects different parts of the market, shields them away from any legal wrongdoing, and allows third parties to join in and buy up any assets from corporations in default, which I thought was very interesting because right now there are 2 million loans outstanding in forbearance, and the forbearance protection plans expire on June 30th, which is at the end of this month. And they also snuck in a rule called ICC-014, which went effective on June 1st, that's this month, which incentivizes them to buy up what are called CDSIs, or credit default swap indexes. And here's what all of that means. Remember how banks were creating these CDOs that then they sold but then bet against? Well, this last rule allows them to bet on an index fund of all the different markets potentially failing, rather than focusing on individual investments, which ain't nobody got time for that. This last new rule allows them to bet and profit off of the entire market failing as an index. It's almost like an all-encompassing insurance policy against failure. So why are they doing all this? Do they not have enough money already? Well, yes. But no. Again, I'm not saying this is what will end up happening. I'm just a messenger here, so I'll let you decide what all of this means. But according to this theory, the reason why all of this is happening is because we're going through another cycle of a consolidation of power. And I know that sounds really evil, like it's some conspiracy theory, but it's actually super simple, straightforward capitalism at work, because companies like to acquire or buy each other out all the time. And this is because they want to create less competition for themselves. But they want to do that when their competition is at its most vulnerable point, and they will do anything necessary to get them to that point, even if sometimes that means crashing the entire market. Is that evil?
No.
And it's not really a conspiracy if you think about it, because that's exactly what happened in 2008 when Bear Stearns failed. JP Morgan was like, they just ate the competition and bought them up for pennies on the dollar. This is when power consolidates, when people are the most fearful. And it's just like Warren Buffett said, it's only when the tide goes out do you see who is swimming naked. I don't know what any of that means, it just sounds pretty cool. But this is why stocks like GameStop and AMC have become such a huge narrative this year. It's not because the media tells us these YOLO kids have forgotten fundamental investing. It's because these stocks have been instrumental in exposing the shenanigans that have been going on about how these institutions are using incredible amounts of leverage to crash and short these companies out of existence. And that's why I'm buying these stocks. It's not because I want to make a ton of money with them and make them a cornerstone strategy of how I retire. It's because I want to see how deep this rabbit hole goes. And I want to see that this time around, it's not another boom, bust, consolidation of power, but instead, boom, bust, pay me my money, Wall Street, checkmate. I did not do that Reddit post justice. There are so many more nuances and details that I left out, like the SLR, which is the supplemental leverage ratio, which you'd see right here. Banks are taking on an extreme amount of leverage to the point where they might not be able to meet their minimums. There are so many things happening behind the scenes that I didn't even get into just because it is so confusing and so convoluted and so hard to wrap your head around that I'm not even gonna bother, so I will leave you to decide. But in the meantime, I'd love to know your thoughts. Is this really something that's a consolidation of power? Is this something that we're gonna kick the can later down the road? Is this FUD? Is this Reddit just having some fun? I don't know. Sometimes I think the internet is pretty crazy, and sometimes it's pretty brilliant. As always, don't forget to smash the like button, subscribe if you haven't already, and go get up to $250 worth of free Bitcoin using this BlockFi link right here. Go get 2 free stocks with Webull. When you deposit $100, those stocks can be valued up to $2,300. Then go track them automatically with my spreadsheet linked down below in my Patreon. I'd love to know your thoughts. I will leave a link to the Reddit thread in the description below the video. Again, I will see you back here on Friday, Monday, sometimes a Wednesday. Love you. I'll see you soon. Bye-bye.